really interesting about all this is that it's actually lifted steel prices. And so the concern that we have is that even though the initial reaction is a fall in terms of iron ore demand, high steel mill margins tend to result in higher iron ore prices because there's enough spare capacity in the system. So to believe this story has legs, you have to believe that the entire steel sector in China is listening to policymakers and are looking to curb production. And if that is true, then yes, this trend has the potential to keep continuing.
And so when you say they're listening to Chinese authorities, are they directed as to what output that they can actually generate?
So certain jurisdictions are certainly under more control of what policymakers say. So say Tangshan, which is a steel hub, which accounts for about 14% of China's crude steel capacity. There's certainly more power there in terms of controlling output. But you go elsewhere in China and it is harder. And so the idea of policymakers being listened to versus making your margin, that is a very key story in terms of the push and pull story of what happens with steel production and steel mill margins in China.
And we've just pinched your chart of the day, Vivek, and I also tweeted this as well. There's sort of always calls for the death of Australian exports to iron ore. And you can see on the screen, to quote your chart, it's been fairly bumpy, but let's face it, that's pretty stable at 16% in recent years. Are we expecting this to decline over time?
Yeah, so look, the risk here is certainly not in the near term. Like we know the problems with Vale, and overnight there was even more concern given that they reduced their end of year iron ore capacity from 350 to 343 million tons a year. So the issue is who is going to step in if China really wants to step away from Australia. And Brazil is just simply not an option on the table. But when we look at what can happen in the medium term, really where the conversation will come from is, okay, yes, we will see Brazil eventually lift output back to potential. But what is going to happen with investment outside, particularly in Africa? And Guinea and Simandou, the project linked there, is the one that I think everyone is paying the most attention to. We're still waiting to see how that develops, but that is a longer term strategy. But even then, we're talking 60 to 80 million tons. That's 4% of the seaborne market. And yes, that will diversify some of the concentration that China has on Australia away, but it's not going to be a game changer. Now, Australia is still going to be very, very relevant when it comes to China's iron ore demand needs. And that's something that we're looking at very closely. But yes, there is a risk that the dependence is lowered, but it is going to still be quite strong even over the medium and longer term.
I think it sounds like we shouldn't be panicking yet when it comes to that iron ore space. Thank you so much for the update, Vivek. Please enjoy your weekend.
No worries, thank you.
And I'll just drop a little note in here. We just had private sector credit from the RBA. Might be worth mentioning that owner-occupied credit has jumped by 0.9% in the month. Just look at my screen here. That is the highest month on month for quite some time. I have to squint to look at it a little closer, and investor credit continues to climb as well. It's only 2% year on year, but 6 months ago it was negative. So that housing market is still certainly on fire. Let's have a quick look at the local market here, and this is still flat. It's just green. ASIC is suing AMP. Again, this time over allegations. AMP is charging fees for advice to over 1,500 superannuation customers despite no service actually being provided. AMP saying it has taken action to rectify the issue, including remediation. Meanwhile, Fortescue said it's teaming up with India's SJW Energy to produce hydrogen and steel in the country. Fortescue's Future Industries arm says expenditure is set to come in between $400 and $600 million. We love CapEx. Sezzle is sizzling, reporting a 95% bump in active customers year on year over the June quarter. The buy now pay later firm also declaring an extra 6,000 merchants are now on its books. EML Payments has won a $270 million tender contract from the government of Northern Ireland. The High Street scheme is set to provide every adult resident in the country with a gift card. The funds in those cards will be provided by the government. And let's have a look at the most followed companies on the ausbiz platform. Sorry, sea of red on this page. It looks like buy now, pay later on the nose. In contrast, banks and miners are holding us up today, both of those in the green. And Asia is slowly opening for business on this Friday. Let's pop in and catch up with Westy for his day in Asia. Good morning, and here he is. Well, the headline is flat today, but how do you think the sentiment is? Are we just marking time ahead of next week's event risk?
Yeah, it's a bit of event risk next week. It's difficult to play it, to be honest. I mean, I think just have a look at what we've seen in the US dollar over the last 24 hours. I mean, overnight it was a broad-based US dollar sell-off. And that helped, I think, risk more broadly. There was a little bit of selling in the bond market, but it was a dollar sell-off, and markets have moved a little bit higher. That has changed and reversed through Asia. Now, maybe that's something to do with Amazon's results. S&P futures are down 1.3, or Nasdaq futures down 1.3%. S&P futures are down 0.8%. We're discounting that now, so it looks like if the US markets were to open right now, it would be pretty ugly, or somewhat ugly. You can look in Nikkei futures; they're down 1.5%. The Hang Seng's down 1%. The China May 50 futures are down 1.2%, and the US dollar started to strengthen. So all that positive affair in the overnight session. People have got out of bed in Asia and said, well, we're not seeing the same dream there, and they've got a bit of a sore head going into Friday. So it's a tale of two halves, really. So we'll have to see how this fares as we go through the back end of the day. Can it get ugly? Well, there's no new news other than the Amazon result, which was a pretty poor result relative to expectations, and their guidance for Q3 is really disappointed. And again, it shows you when these mega cap names are priced to perfection, you absolutely have to slog it out of the park. Otherwise, you're going to attract sellers and profit takers, and that's what's happened. So, yeah, I don't know. Maybe there's some renewed bearish bets going on about China, given with the volatility we've been seeing there. Maybe it's Amazon's numbers, but the US dollar's stronger. We're seeing a little bit of a defensive play coming through Asia, and the ASX is tailing off a little bit. Look, we've still got materials and at the top of the pack, which is great to see. Financials are holding in okay, but it does feel that after a really nice night last night, good night last night, that sentiment seems to be souring. And look, we're going to go ahead next week into what is arguably a big week for risk. Manufacturing numbers out of the US, manufacturing globally, and then of course you've got the Mac Daddy there, the payrolls number in the US, and we're looking for some really big numbers. The market's looking for 920,000 jobs, and the unemployment rate to tick from 5.9 to 5.6%. How much does that meet the substantial progress test? We know there's progress. They talked about that yesterday, but will these numbers start leading into substantial progress? And then we start getting a taper decision sooner rather than the December meeting, which is probably my best guess at the moment. So, look, watching that sentiment, it seems that, as I say, in a long-winded way, it does seem that Asia's seeing light in a different way there.
It's sort of quite interesting to contrast the US because, as you say, when the market's priced for perfection, they seem to sell off on anything that's less than absolutely outstanding. And yet here, we've only had a few snippets here in Australia ahead of the proper reporting season, and yet our market just seems to go from strength to strength. Why are we optimistic down here, but you're selling optimism in the US at the moment?
It's a great question. Look, I think the US would be lower than where it is at the moment. I sort of take I'll approach this from looking at the US first, but I think the US, the S&P and the Nasdaq and market, well, certainly if you take the S&P, I think the S&P would be lower than where it is right now if it didn't have the mega cap component being such a large weighting. And we've just seen such aggressive rotation. One day value's working, next day growth's working, and they just continue to work out. And as soon as we see a shock to the system, it's a 2-day affair. Everyone piles into mega cap tech because that's seen as quite a defensive duration asset now, and because of the weighting in that sector, it supports the market. So you've got, US markets probably would have had a 5% move down if it wasn't for the weighting that the defensive mega cap situations has. Look, we're a value play, so maybe value is going to outperform if we start seeing bond yields moving higher. Growth will take a bit of a backseat. We'll have to see. Obviously, if we do see a sustained sell-off next week in global bond markets, if we get a better ISM manufacturing and if we get a better payrolls number, then value will outperform. But we are when you're talking about global developed markets, we are, probably the ASX and the FTSE are the pinnacle of value investing in those situations there, given just the weighting that materials and financials having on our market, and also the idea about dividends. And we go into the earnings season, one of the big factors we are going to be watching, and we've seen a case in point today with NAB buying back stock. I suppose it's not a dividend increase, but capital management's going to be a key factor that we are going to be watching through the earnings season there. So if companies are producing cash, then they're going to be giving it back to shareholders, and I think that's going to be something that we're going to be watching and reinforce the idea that if you want value in the market, there's probably no better place to go than the UK and also Australia.
And speaking of Australia, I'm not going to let you go because we know it's reporting season, but we are also going to have RBA saturation. We've got the meeting on Tuesday with all the fun of a forecast upgrade, which we get on Friday, as well as the laborious 3-hour testimony. So can't get enough. Can't get enough.
That's for you.
And of course, believe me, it used to be 6 a.m. Singapore time. I do not miss that. But the point being, it feels like the FOMC just seems to come and go, and we just wait till year end. And yet we have this unhealthy obsession with what the RBA is going to do next week. Are we in recession? Are they tapering? Are they not tapering? From your perspective, is it going to come and go as well, or will you be watching the headlines?
I'm interested in what the market's telling me. If I look at Aussie dollar implied volatility, 1 week implied volatility or 1 month, it's still really super low. So the market's not expecting fireworks. Is that right? Obviously, options traders buy and sell volatility based on where it's priced, but the market at the moment is not expecting any kind of major fireworks from the Reserve Bank meeting, and obviously we've got payrolls and everything that comes into the Aussie dollar equation. I think Citigroup put the cat amongst the pigeons this morning by putting out a note saying that they now expect an announcement next week from the RBA to delay that tapering exercise because predominantly of what's happening in Sydney and the New South Wales government obviously increasing the funding requirements going forward by quite a substantial amount. Hasn't necessarily seen too much of a weakening of the Aussie dollar. I mean, the Aussie's down a bit today, but it's outperforming the Kiwi and some of the other risk currencies as well. I don't know. I mean, I think obviously everyone's watching for a formal commitment from the Reserve Bank to delay that tapering, which is only supposed to start in September. The question then becomes: is will this? How much is that already discounted? Will it create any kind of fireworks? If we look at the yield differential that we're seeing, if we take the 5-year part of the Treasury curve, Aussie government bonds have been significantly outperforming, the likes of the UK, for example, and that's why sterling Aussie is doing what it's done, Euro Aussie has done what it's done, and so I think a lot of it is probably priced into markets. This idea that they're going to probably delay tapering, I think people have already taken that, so there shouldn't be too much in the way of fireworks. But yeah, look, I think the Aussie's looking pretty weak at the moment for obvious reasons, and I think a lot of that is down to the fact that we've seen such good outperformance from Aussie bonds, especially in the belly of the curve, and I think markets are discounting a slower rate of growth going into Q4, and Q3 is going to be pretty much a horror fest there. So we're not expecting fireworks, just to surmise, but I think a lot of it is probably discounted now, that the idea that they're going to delay tapering.
Yeah, I think that sounds about right, but of course we'll get your views next week. Thank you so much, Westy, for joining us. Enjoy your weekend.
You too. Take care.
And today's corporate news kicking off with NAB to buy back up to 2.5 billion of ordinary shares and in August and restore its Tier 1 capital level towards its ratio target. Over in the energy space, Origin Energy shares have not had a good time, I think down 5-6% to a 2-month low after revealing more than $2 billion worth of impairments, and this is despite a roundly positive longer term outlook. Origin confirming its full-year earnings guidance while recognising the impairment cost could be up to $600 million. Meanwhile, shares in Whisper are crashing after the software platform warned investors of an upcoming hit to full-year revenue as the coronavirus impacted customer additions over in Asia, down nearly 12%. Meanwhile, Seven Group continuing to snap up Boral shares. The update now is just shy of 70% of the company. And earlier today, we found out Ryan Stokes has been appointed chairman of the board, with several Boral directors set to retire after the company's AGM in October.
Is partnered with City Index. Trade share CFDs, Forex, cryptos and more with a trusted provider.
Is this market one giant bubble? Well, nobody knows for sure. But if there is a pop, you won't find us in a panic because we understand market cycles.
Inflation went to 14%. And I was paying 17% on my mortgage.
I've seen the markets come and go over all of these economic shocks.
The best traders on the floor kept a cool head and stuck to their strategy.
Meme stocks mooning, crypto popping. When you see things like this, it's time to be cautious.
We examine everything that will help you make an informed investment decision.
I've seen it all before.
I'm Cara Altway and you are watching The Trade.
That's a proper double bottom, you really need to respect that level.
You need to really understand what you're doing, what your objectives are.
It's all right getting into something, but how are you going to get out?
Well, the devil is all in the detail when it comes to chart analysis.
You've got to look to different currencies.
You know, you look at the numbers, the moves it's made, it'll keep going higher.
I actually don't think it's a great business.
The story is a great one, but it's a perennial loss maker.
The demand for this is way more than we even anticipated ourselves.
Can I do a table thump
Yes.
up? It's a buy.
Buy.
Absolutely.
The Call. Watch it live, on demand, or listen to the podcast. Every weekday on AusBiz.
There are various uncertainties in the sectors that we operate, but our focus is really to outperform.
At the appropriate time, we'll certainly consider a range of different capital return options.
That means that we can continue to generate strong cash margins regardless of the cycle.
Profitability at a group level is really dependent on how fast we want to push international growth.
I think this speaks to the strategy of oOh!media in that we have a very diverse set of assets.
And switching gears to the economy now, with EY running the ruler over this extended Sydney lockdown, and the numbers are eye-watering to say the least. To find out what they are, we spoke earlier to Joe Masters, Chief Economist at EY. Take a listen.
So, you're absolutely right, Andrew. There's a lot of moving parts.
we've learnt a lot about lockdowns, so we know how they play out, but every lockdown is different, of course. So what we've done is we've modelled the economic impact of restrictions as at the 26th of July. So that's when we had South Australia lockdown, Victoria under lockdown conditions, Greater Sydney lockdown with those additional restrictions on construction. And our estimates are that that costs about $2.8 billion a week. Now, as you said, we've then got to make some assumptions about how long those restrictions last and also how quickly we come out of them. It's pretty clear in Delta that the path out of lockdown will be a slow, gradual grind, not a snap back. So our best estimates are that when we take all of those parts, the hit to quarterly GDP in the September quarter will be 2.5 percentage points. So that's enough to give you a contraction of around 1.5 to 2% in the quarter. And we also looked at the impact of that on hours worked, and our modelled estimate is 160 million hours of work lost during these restrictions.
So you're expecting that will be where the hit is as far as employment is concerned, hours worked rather than job losses?
So we're going to have a whole heap of definitional issues like we did back in April and May of last year. We will see, unfortunately, some Australians lose their job. Some of those will also not start to look for another job because there are simply no jobs available if you work in retail, for example, and retail is closed. So they'll actually fall out of the workforce, which means reduced participation. And the two of those together mean that the unemployment rate won't go up quite as much as many people might think. But as you said, where we will see it is a big loss of hours worked and a significant rise in underemployment. So they're people that are still technically employed, attached to their employer, but not working any hours.
Okay, Joe, so what factors will be in play if Australia was to tip back into recession? So forecasting negative growth this quarter, what would need to happen for December to be negative as well, just as far as perhaps, do you have a timeline in mind as far as that Sydney lockdown is concerned?
So the way that we think about it is to get a second quarter of economic contraction is reasonably difficult. That's why we don't see them very often, right? And what you need to do is get the level of activity to fall further in that second quarter. And when we think about that in the context of lockdowns, that means you would have to have a tighter level of restrictions or lockdowns in the December quarter than you had in the September quarter. And that seems unlikely. It is likely through the December quarter that Sydney will start to ease restrictions, not tighten them further. Now, never say never. It is possible that Sydney does do that we have a prolonged lockdown of the construction sector, for example, or more likely that we get extended restrictions in other parts of Australia. But at the moment, the most likely scenario is that cases are starting to improve, vaccination rates are starting to improve, and that the overall level of restrictions through the December quarter is less than it was in the September quarter.
Just very quickly, Joe, the construction sector that's gradually reopening as of next week, how critical is that, I guess, when you consider the flow-on effects from construction?
It's critical. When we closed it down, it doubled the weekly economic cost of lockdowns in Greater Sydney. It's a big part of our economy, and it has a big multiplier. It's very engaged up and down the value chain. Our estimates are that easing the cost of restriction outside of those 8 impacted LGAs means that the cost of the economy is gone, is about a third of what it was. So it was about $1 billion a week just from construction. Now it's about $360 million a week.
And that was Joe Masters, Chief Economist at EY. Let's have a quick look at our chart of today. There's no labels on here, but what I can tell you is that 31% is a record gap between the price of houses and the price of apartments. As you can imagine, apartments are certainly at saturation point and houses are looking very attractive. Of course, if you love charts, tune into 2:45 p.m. and listen to Cara on the Trade. And that's it for us. Of course, we've got the call. Adam Dawes from Shaw and Partners and Claude Walker from A Rich Life will be joining us for a deep dive on your stock picks. Stick around.
Hi everyone, I'm here to find out a little bit more about sustainable investing, and to help me understand what it's all about, Katie Constance joins me now from Fidelity. Katie, welcome to you. Now, exactly what is sustainable investing?
So sustainable investing, which can also be referred to as ethical, responsible, or ESG investing, is a long-term investment strategy which seeks to integrate environmental, social, and governance considerations into its process. Environmental issues can include climate change, deforestation and pollution. Social issues can include modern slavery and child labour. And governance issues can include executive remuneration and gender diversity. What sustainable investing seeks to do is invest in companies with strong, sustainable characteristics.
Is sustainable investing increasing in popularity?
So over the last decade, sustainable investing has become increasingly important, and there are now over $1 trillion of assets invested in a sustainable manner in Australia. There are a variety of reasons why investors choose to invest sustainably, and that can be to align their investments with their underlying values and beliefs, to diversify their portfolio, or to reduce risk. At Fidelity, our view is that by investing in companies with strong standards of sustainability, we can protect and enhance returns for our clients and contribute to a more sustainable financial system for society as a whole.
Some great insights there. Thank you, Katie.
Thanks, David.
Look out for more of our sustainable investing insights with Fidelity, or visit their website.
5-star investing starts with NabTrade, proud sponsor of The Call. Find out more at nabtrade.com.au/The Call.
Hello and welcome to The Call. I'm Andrew Geoghegan. Great to have your company. Today, of course, 10 stocks picked by you, 2 experts, 1 hour. It is Friday, the 30th of July. Great that you can join us on this Friday. Let me introduce our 2 experts joining us today via Skype for the next hour. Adam Dawes from Shore & Partners and Claude Walker from A Rich Life. Adam, Claude, welcome.
Thank you.
Claude, how are you looking at the market? How are you looking at the market at the moment? Because obviously we've seen a strong session on Wall Street overnight. A bit of data to consider. Of course, that overhang in Australia is all about COVID at the moment, with predictions that we're going to be slipping into negative growth this quarter. It's likely to impact company growth going forward, is it not?
So the only thing that I've done in response to the current situation in Australia is I've sold out of one of my discretionary retail stocks, Dust Group, and which I did at slightly above today's levels because I figured that the outbreak would hurt their sales. And I have invested quite heavily in a company that's profitable and dividend paying, and I think is going to be a beneficiary of the outbreak. That's the only real response. I guess the overall movement in terms of the last 6 months, almost really 6 months, I guess at the beginning of this year, a lot of the tech and growth and software that I invest mostly in has been on quite high valuations. So I guess the main movement for me has been rotating out some of those very high valued software stocks and trying to find some ones that offer slightly better value and that I think are still relatively under the radar.
All right, well, that makes sense. Obviously, you've got to keep active, particularly in this current market. Adam, how are you approaching things at the moment? And interesting, obviously, we're on the eve of reporting season. We'll be looking for guidance, but that won't necessarily be forthcoming.
Yeah, you're right. And I think that's one of the key things that I'll be looking for in this reporting season is those outlook statements, and then really going on from there, how those outlook statements are going to be tempered. And I think a lot of companies are going to pull back expectations and even potentially, which I'm not really too happy about, but also pull back on dividend forecasts as well. So there's some key things that I'll be looking for. Look, I think this market has pretty much taken the COVID issue in its stride. And I'm really sort of comfortable with some of the other companies that we've obviously got investing in. And certainly the material stocks continue to do well. The banking stocks continue to do well. And they're 2 key things that I'll be looking through this reporting season. What are the dividends like in the material sector, but then also the outlook for the market in the banking side as well. So it's going to be a little bit of a mixed bag, I think, this August.
All right, you mentioned the banking stocks and dividends. Let's get to that for our stock of the day, and it is NAB. In fact, NAB out with news this morning say it will buy back some $2.5 billion of its ordinary on-market shares in August to help restore CET1 capital levels towards its ratio target. And the Chief Executive, Ross McEwan, saying NAB's strong financial position, along with the divestment of MLC Wealth, has led the bank to look further at ways to return capital to shareholders. And the buyback, as mentioned, will begin next month and equates to around 2.9% of NAB's market capital, and follows, of course, ANZ's $1.5 billion buyback announcement earlier this month. Adam, how are you looking at NAB? I guess no surprise, given where the banks had to position themselves at the beginning of the pandemic.
Yeah, it is, and it's really welcome news to shareholders to get that $2.5 billion. I think $2.5 billion is a fairly decent number too. It's fairly large comparing that to ANZ, and I suspect most of the banks are going to follow with asset sales as well as other things that they've been doing to sort of give back a little bit to shareholders obviously a buyback is positive for the share market or for the result of the shares. I do feel though that it would have been nicer if they sort of bumped up their dividend, but I think that they're potentially looking to have a better dividend this year or this half anyway. So look, I think it's a positive move for the sector, positive move for the stock, and I think depending on your individual circumstances, you would potentially look to take some of that buyback up.
Okay, so do I take that as a buy, a hold? What are you looking at? It's a buy. Okay, yeah. Claude, maybe sort of banks not your thing, but how are you looking at NAB?
Well, I guess so. In terms of the actual news today, I guess I'm probably not an expert in this area, but I would have thought that the share price movement today, which is basically flat, should probably indicate that this isn't hugely. This shouldn't really change the overall thesis. This buyback, I guess it was probably already largely expected or priced in or something, because it's up about the same amount today as the other banks. And so I guess that doesn't change my view of it, to be honest, in terms of looking at the long-term NAB. But then I would actually encourage people to look back a bit further, say at least at the 5-year chart. I don't know if we've got that. But if we can just have a look at that 5-year chart, then basically we can see that the share price has gone nowhere over 5 years. So I would say that, I would argue that except for the dividend, which is fine. If you're a dividend investor, then, maybe own banks. Another way to play it is just to, and I'd put this, to Adam, would you index for the dividend own the banks? Because if you actually just own the ASX 200 index, then you actually are owning heavily the banks because they're such a big part of the index. You just got a bit of other diversity in there. I'd argue it's a bit safer. Now, in terms of compared to the other banks, then yeah, actually NAB probably looks pretty good to me. But overall, I just don't get why individual investors, who wanting to spend time thinking about stocks and try and hone their skills to be as valuable as possible. I just don't think you're looking at the right place if you're looking at NAB. You're going to compete against a legion of people that are full-time looking at banks, advising big funds and that kind of thing. If you're just an individual investor, your advantage is in the smaller end of the market where there's not a legion of analysts and maybe these companies don't have relationships with brokers and there's more equal access to information as well. There's not private meetings between the company CEO and analysts and stuff like that. So I had a stock that's literally up 90% today. Now, obviously that's a lucky result for me on this exact day. But that's the kind of thing that's possible in small caps. A news can move the thing 90%. Now, I'm not saying it deserves to be up 90%, but the point is that that's where I choose to play. So in the broader scheme of things, I guess that's why I don't spend too much time thinking about NAB.
All right. Hey, what was that stock? What's that stock that's up 90%?
Oh, that's a company called 8Com, and I actually sold a little bit this morning, so I wouldn't rush out and buy. But that was a crazy move. I've not seen something like that very often.
All right. So your recommendation for NAB then?
Yeah, I would just say, look, honestly, if you own it as part of an index or if you're a long-term dividend investor, hold on. But otherwise, I wouldn't be buying, no.
Okay, all right. Okay, so that's NAB, our stock of the day. Now let's get right into it as far as our first stock. And now this one requested by Simon, and he wants us to take a look at Namoi Cotton in the ag space. Yeah, you're waving at it for a very good reason because he wants to start with you because he says you mentioned previously on the show that you find the ag sector too risky. Now he's saying, I'm determined to get Adam interested in at least one of Australia's great ag companies. He says he's a farmer in New South Wales, has a small holding in Namoi, which he purchased earlier in the year off the back of sharp improvement in those seasonal conditions, which we've seen particularly on the east coast of Australia. So he wants to know your thoughts on that one, Adam.
Yeah, well, thanks. Put me right in the middle of that one, and thank you to the viewer as well. Absolutely right. I don't like a lot to do with agriculture. I think it's got huge risks all the way through this one, and I'm just a little bit cautious on most ag stocks as a rule. Look, this one actually doesn't look too bad. Doing some work on it because obviously my name was attached to it, so I really had to look into it as well. But look, I think this one looks okay. I mean, obviously with agriculture, you need to have a couple of things. You need to have good soil, rainwater, and right temperature. And I think we're getting all of those with the sort of the bumper crops. And most analysts that do look at this one, NAM, are predicting that there is some very large crops that are going to be coming through. Obviously, it's a little bit thinly traded where it is at the moment, but look, they have raised some capital to strengthen the balance sheet. They are trading at a material discount to NTA at the moment, and they are one of the leading cotton producers here in Australia as well. So we expect most analysts are expecting earnings growth potential in the next coming couple of years. So for me, I'm going to stick with my rules because, as Claude knows very well as all of us in our investing world, you've got to have rules and you've got to stick to those rules. I think that's really, really important. One of my rules is I don't get involved in ag stocks. Look, I think this one, if I was pushed, it would be a hold from me because of the backdrop with the extra seasonal rain, soil moisture, those kinds of things. Cotton's a very water-intensive business, and that's one of the things, obviously, when Australia does turn around and has that drought, which potentially could happen, that's something that you'd be a bit cautious about. But if I'm pushed, it's a hold from me. But I'm going to stay with my rules, and ag stocks are something that I don't look at.
All right, stick to your convictions. Sounds good. Adam, Claude, it is Australia's biggest cotton processing company, but as Adam mentioned there, agriculture does bring some risk.
Yeah, absolutely. And I love Adam's synopsis then. That's actually going to be the same thing for me. I do have a rule against ag stocks, but I actually have to say that I think that this one is very interesting, and it's probably your best bet, your best bet to get someone across the line on ag stocks when they wouldn't usually invest in it. Now, I think the thing that you've got to understand about this company is historically it's had a board and management that it sort of had split loyalties between, I guess, the growers, because this thing started as a cooperative, right, for cotton growers, and they had a lot of control when it was first listed. So there's been this tension between growers and, I guess, shareholders. And when it comes down to it, I think the whole thesis that things would change, things would be better off now, is that basically that in this day and age, after they've had some big changes to the board over the last few years, the argument of, my friend Andrew Brown, who covered this in his fund letter called E72, you definitely, if you're interested in this stock, you've got to read Andrew Brown's history of Namo Cotton in his investment letter. It tells you about some of the difficulties they've had in the past, the management missteps, and why it's so cheap. Because basically the NTA, according to him, is about 68 cents per share. Well, the share price is under 40 cents per share. So this is like a typical cigar butt investment. You're just trying to buy shares and hope that actually the market says, well, $1 is worth $1. And in order for that to happen, they need to start paying bigger dividends and paying out that profit to shareholders and convince the market that the shareholders are going to share in the spoils of the cotton. And if that happens, then you should get a re-rate. So if you're buying now and then they start paying dividends, you get the dividends and you probably get a re-rate as the market decides, hey, come on, these guys are actually okay now. And, supposedly the directors have made clear their intention to pay dividends in average or above average cotton season. So if our viewer is feeling bullish as a farmer, he might know better than me, if it's going to be a good cotton season this season, next season, then I'd say that there is a viable thesis there. I wouldn't be a long-term investor in an agricultural company, but if you're buying now for the re-rate and the improvement, I think it makes sense as a thesis. So I'm going to give my tick of approval to the thesis, but myself, personally, I don't invest in agriculture stocks either, and I don't have the requisite domain knowledge to feel very confident there. So, it would be a no for me personally.
All right. Well, yeah, Simon, our viewer, does have skin in the game, so you can understand his perspective there. All right, that's...
he might be in a good position.
Yeah, well, absolutely. Okay, that's a no from Claude, a hold from Adam. Okay, let's move to the space of health tech. And Teotech, ticker code ADO. Now, Will, he's saying this company is in the field of rapid testing for COVID and recently announcing a distribution agreement in the UK. Of course, this is likely to get attention locally in New South Wales, with the government seeking that sort of technology as they're dealing with the current COVID outbreak there at the moment. Claude, do you like this space in general, and specifically, obviously, when we're taking a look at Teotech?
Well, yeah. So let's discuss what we think what this space is. So you could say this space is like med tech and stuff, which is obviously definitely is the space that I invest in. And look, once many years ago, as a tech investor, I did have a very close look at Antio and kind of even thought it sort of believed it a little bit. But really what I think this space is with Antio Tech, it's the space in which you have companies that are constantly trying to raise capital from shareholders. And you'll have noticed that around the COVID outbreak, suddenly a lot of companies were doing COVID testing or COVID this, COVID that, cleaning. We had a hand sanitizer company that went to the moon and then back down to Earth now. It's in that space. I would say Antio is in the business of raising capital from shareholders. And, these things go in cycles, because if we get that 5-year chart up or even longer, you can sort of see that back, maybe you have to go back 10 years now, but like there was a massive hype in this in like 2013, I want to say. So way off the left of that 5-year chart, there was another big spike that went up to about 40 cents or something like that, right? And that was the last time that the share price, got super hyped. And actually one of the main guys promoting that was a guy called Matt Sanderson, who had a blog called visioninvesting.com.au. Now that no longer exists, but if you go on the Wayback Machine, you can still find that website. And you can see in like 2016, again, off the left of that chart, there's a big, capital letters, Antio set to launch disruptive product for lateral throw testing at AACC 2016, and all of this sort of exciting stuff. That guy actually subsequently became a director, had a blog about how good the company was and how he was investing in it, and then he became a director of the company. This is all way back. So this is how I feel old. I've been doing this long enough. I remember when there was hype about Antio Tech 10 years ago, and it was the same story then, and everyone was exciting and the share price went up and up. And unfortunately, I was like somewhat of a believer at that time, and I thought as it was going up, well, maybe this is something. Of course, nothing. It's nothing. Like 10, that was in 2015, say. It's more than 5 years later. For the last 12 months, they had receipts from customers of under $1 million. That's under $1 million. This is a story stock. Now, the share price might go up and down. I'm just one person with a long memory. I can't stop it if 1 million people are going to go out and tweet and say how great this stock is. I can't stop it. There's a story. They're selling COVID tests now. Oh, they're the only people doing that or something. And, hurrah. I'm not going to affect the share price. I don't care if it goes up. Go for it. But if you're a long-term investor looking for a serious long-term investment, then this is definitely not what I would be looking at.
All right. Well, I'm taking that as a definite no then from you, Claude.
I've got more on that as well, but I just had to stop my rant.
We don't have time to do that. But Adam, a bit of a history lesson there on the company from Claude. So what's your perspective then?
Claude, I can't see the grey hair, mate. I mean, you deserve to have some grey hair after that history lesson, yeah?
Yeah, maybe. Anyway. One day it's coming.
One day. It will, trust me.
All right.
Yeah. So ADO, look, I'll go. Claude's given us the history. I'll sort of go to now what they're actually doing and what we sort of think of the business. From me, it's an interesting one. It's certainly one that it would be too high risk for me to look to invest in. So if you hold it, that's fine. But I wouldn't be putting any fresh money into it, and I'll give you the 2 reasons why I wouldn't be putting any fresh money into it at the moment. But look, they've got they say they've got a decent platform, which is the Eugenie platform, and it's one reader that reads multiple tests, and hence they're saying multiple revenue streams coming in. So this reader has chronic conditions, sepsis, COVID-19, bacterial diseases that you can test all from the one machine. So that actually sounds pretty good. But what's happened is obviously with these businesses, they can't get out and they can't go to hospitals. They can't because of COVID, these kinds of things. So their sales strategy is basically now they're going to have to look at multiple partners in multiple sectors or countries to then get that moving. So what's happening is that they have to then rely on another third party to do their sales work for them, which we found out from a lot of other biotech companies that they, unless they're paying them top dollar, which means their margin gets squeezed, that they're not really going to put these products in front of other products that they're going to make some more money out of. So that's the first thing. The first thing is that always be careful with these extra distribution deals that they're talking about, because I don't think those distribution deals work too well. The second thing is that it isn't TGA approved, and we're looking for a TGA approval to be coming out in September. Now, TGA, obviously, the Australian Therapeutic Goods Administration, obviously that's not the US or Europe, that's just here in Australia. And that'll be in September. Now, potentially that will be an uptick in the share price if that does get approved through the TGA. So what I would do is you would hold and wait for that announcement to basically, if it's a good one and they do get it approved, then it really then changes the story of the stock, because then it's all about product sales and revenue. So for me at the moment, it would be a hold if you hold it, due to the fact that there's a couple of risks still in this stock at the present moment.
All right, that is Anteo Tech. Moving on to our third stock. Now, this has been in the news recently, Iress. Of course, the financial software services software group. It's knocked back a unsolicited takeover bid from the private equity firm EQT. Iress Board essentially saying it's not good value. Adam, can we expect bids forthcoming?
Yeah, look, it's an interesting one, and we've seen a lot of mergers and acquisitions in our market at the moment, which sort of says to me that this market is still fairly hot, and there's a lot of activity because, even for the likes of something like a Sydney Airports or a Crown or those kinds of things, these are these businesses that have been absolutely downtrodden. There's no money going into them. There's no revenue, but big organisations can look past the COVID valley and they can see that this is something that they would want to be investing in for a 10, 20, 30-year time horizon. So it's really quite good that these kinds of things are actually being picked up. Iress, I think, is actually a really interesting story. I use Iress every day in our buying and selling and trading on the market, and I think it's actually quite a good one compared to, obviously Bloomberg is a little bit better, but Iress, I think, works well. It's quite interesting when you look at the actual announcement. It is a confidential, unsolicited, non-binding and indicative proposal. So if you could put any more words in between the takeover bid, basically they're saying, look, we want to get access to your data room, but we're not going to give you any guarantees that we're going to make a bid. So for me, I think this one is a wait and see. The bid is certainly looking at $14.80. It looks like the share price is still a little bit below that price, which basically means that the market is not willing to take a bet that this thing will go through, and I don't think that there'll be another bidder for it. So I'd be cautious here. It would be a hold, wait and see. For me, in takeovers, I always wait to the 11th hour to see if there's another bid. If not, sell it on market and move on to something else.
All right.
So It's a hold for me.
It's a hold.
If you've got that, that's a hold.
Okay. Yeah, absolutely. Claude, your thoughts? Somebody think another bid is likely?
I don't know how likely another bid actually is. Already it seems like the price that they're offering is fairly full to me. So having said that, it's not crazy. It's only, I think, about 10% above the actual current share price. So it could be. I definitely wouldn't be selling this now if I already held it, because it's not crazily priced, but at the same time, it's not really a high growth, exciting business. Now, you could argue that its prospects in the recovery in the UK are quite good. So I think that would be a reason to potentially hold the business, even if you just put aside the potential of the bid coming through. But then with that potential of a takeover happening maybe 10, 15% above the current share price, that's some nice little short-term upside. So yeah, so for a long-term holder who, just likes this as a dividend-paying business, the great thing about Iress is its products are so sticky, right? So you can have a fairly good confidence that this thing will still be, if it's still listed, will be paying dividends many years to come. And I think it's a yield of a bit over 3%. Perhaps Adam can correct me there if I got that wrong. But, I think it's pretty reasonable. Again, not my kind of kettle of fish, just because there's not enough obvious upside. But I do think that the risk reward is probably pretty decent. And it's definitely among the bigger companies that I would say I sort of find more interesting. And if you said, oh, Claude, you only have to invest in big companies, then this is probably one I'd go for.
So that
but
is
still a hold for me.
A hold.
A hold for me, yeah.
Okay. Yeah. So that question, in fact, came to us from Ben. So that's a hold from both Adam and Claude. Let's move on to retail. In fact, it's the Reject Shop, and Jin wants to know about it, saying that it's selling in England at Tesco, getting more into the Australian-made products, yet it has been smashed as far as its share price is concerned. A lot of that, the blame has come down to those lockdowns we've seen across the country. So the question is, would you be buying it at these levels? Claude, what are your thoughts?
So the reject shop is, like, just historically, if we look at the longer term graph, it's just a massively volatile stock, which I think reflects the underlying business is super volatile. Volatile, it looks like it's just down in that one, but that's because the starting point during, an exciting moment for it. But the reason its profits can swing around so much is that, it's quite low margin. And so if it has more volume, the operating leverage kicks in and the profits are quite high. And then if it has less volume, then suddenly it can move into losses and stuff like that. And then, suddenly people are worried about if it can pay its rent and whether it has debt and if it needs to raise capital and that kind of thing. So low margin business that's volatile, that is basically the opposite of the kind of business that I invest in. Like, you just have to remember here, there are two kinds of things you're doing on the stock markets. One is going to be a short-term trade. So you've got a clear thesis. It has an expiry date. That might be something for reject shop. Like, there's going to be better sales coming forward. Their profit's going to spike. The share price will go up and then I sell. That might work for the reject shop. But I don't know how you'd formulate that thesis right now with lockdowns coming in and everything. So, yeah, I would say pass on the short-term trade thesis. And then on the long-term thesis, it's just such a dangerous place to play. You saw that long-term share price. This is a difficult business. It's like literally the opposite of good quality business. I'm trying to look for high margins, sticky recurring revenue, like we're talking about with Iris, really built to last. I'm not there. Like, how many competitors to the reject shop have, just disappeared over the years? What's the competitive mode? It's just a really difficult area to play. So yeah, that's an avoid from me for sure.
An avoid. Yeah, well, you've rejected the reject shop.
Always.
Yeah. Adam, what are your thoughts?
Yeah, I'm with Claude on this one. It's a sell from me. I don't think that there's a lot there that you'd be really sort of comfortable with. I did hear you say about Tesco. I think Tesco's actually exited that global, or has exited with the reject shop. They've exited that global wholesale agreement. Tesco's has said that they'll continue that product line or those product lines through till end of Christmas 2021, but then they're basically going to be finding or trying to help, because the reject shop had a very good relationship with Tesco, and they've basically said that Tesco is going to try and find them another alternative for some of their top selling lines. So I think that was a big thing. A little bit of a history lesson on this one. Is that, before COVID, these guys, basically 2019, 2020, I think at $2.70, they raised their entire market cap again to keep the business alive. Then they got a takeover bid from a US business, and that's where you can see that from in that bottom of 2020, and then it rallied up to get there. So then from there, obviously, then the stock has been moving sideways as well. So look, I think the risks to the upside is that they got, they've basically got to continue the store rollout, and that's the whole thing about these stores is that momentum moving and that rollout. But then also, I just think that $2 stores, that kind of thing, it's at that lower end margin, and I think those margins are really tough to come by. As Claude said, it's all about volume, and these guys really aren't getting the volume at the moment. So yeah, it'd be a sell from me.
Okay, that's a reject shop, rejected by both Adam and Claude. To our fifth stock, and this is coming to us, in fact, it's coming to us from Charlie, Web Central, and he wants to know an opinion. It is a digital services provider, ticker code there, WCG, and I think it just participated in a merger, did it not, with 5G networks. Adam?
Yeah, it's an interesting one, this one, and yes, they did agree, and I think 5GN actually tried to make a takeover bid for it, and then and someone's going to correct me on this one, but I think then they went to a merger, so the sort of merger of equals, and I think that's now started to go through. Look, Web Central, and again, I'm sort of going out. Was this the old Melbourne IT business? I'm not too sure. I'm going to have to.
Yes.
It was.
Yes.
Yeah. Right. Yes. So. This one's a tough one for me. If it's the old Melbourne IT business, that's been absolutely hit pretty hard. Look, it looks okay on the chart. I just think that obviously the merger is going to create some value, and I think that's a real positive for the business. But yeah, for me, it would, if you hold it, then I'd be okay to hold it. But I suspect most people have held this from higher levels, and so they're still pretty hurting. So look, for me, it's probably a hold. Yeah, there we go. You can't see too much going on this one, and it's a really tough space. So for me, it's a hold. Let's see how this merger works and see if they can get the synergies, and then we might have to revisit it. But yeah, for me, at the moment, hold.
Okay, I get the sense we're going to get another history lesson from Claude here, given you're talking about old Melbourne IT business.
People underrate the value of history. Like, if you
care about context,
if you care about making money, one of the best ways you can get an edge over other market participants is to actually study people and study the culture of organizations. And this is the third name that this company has had when it's been listed in the time that I've been following it. It was Melbourne IT, and then Adam missed out Arc Group, and now it's Web Central. So, like, how many times they have? Oh, now it's going to be 5GN, right? Because it's going to get merged into another one. So, I get the real question is, do you want to own shares in 5G networks, basically? And that might be the right kettle of fish for some people. In some ways, that's the chart that we should also look at. Basically, the thing is that 5G network is just this roll up of, in my opinion, mostly sub-quality, not so good businesses in the sort of IT, managed services and connectivity and telecommunications space. And it's an interesting one because for those kind of businesses, because they use shares as currency, as their share price gets higher, the value of their currency goes up, and then they can make acquisitions sometimes at good prices using that high valued currency to sort of keep the thing going and keep boosting their earnings and stuff. But what I think is that ultimately what networks is basically a collection of mostly subscale, but also really like just sub-quality IT kind of businesses. And even though there's definitely the possibility that the share price of 5G networks could get undervalued, and maybe it's more on the undervalued side right now, it's come down over 50% from the high. So you just want to be careful with a business like 5G network. You don't want to buy into the narrative like it can go on forever. These acquisition roll-up strategies categorically cannot go on forever. So, you want to be careful about what price you're playing and what you're holding at and stuff like that as well. So yeah, for me, it's probably an avoid, because I think that 5G network is too far into its roll-up journey. A lot of the easier targets have been going, and generally speaking, things will probably get harder for it to keep the acquisition train going. So yeah, it's probably a no thank you for me on Web Central and 5G networks.
Okay, that rounds off our first 5 stocks. In fact, let's just get a bit of a summary of where we're at. So we began with Namoi Cotton, which was a hold from Adam, despite his saying he doesn't really like agriculture. He sees that as a risk. And Claude, there's a no from Claude, pointing out that historical tension, particularly between growers and shareholders. Antio Tech, that's a no from Claude, essentially saying it's in the business of capital raising and has a bit of a history of hype. Adam's saying it's a hold. Once again, too high risk and no fresh money. Iris has been in the news as far as that takeover bid was concerned. A hold from Adam. He uses it every day. That's got to be a plus. And also a hold from Claude, finding that stock interesting. The reject stop, as I mentioned, I can't help it. It is a reject from both of them. Massively volatile, saying Claude, and particularly as far as those tough margins are concerned, it's a sell from Adam and a void from Claude. And just finally, Web Central, a hold from Adam, and Claude saying it isn't a void. Makes the point historically, which is that has its third name now. I guess that is a bit of a worrying sign if you're continually rebranding the business. Now, of course, on the call we've got our own portfolio, which we've been tracking since July 1st last year, thanks to our partner NabTrade, and all the stocks that get the 2 thumbs up or a buy from both of our exports on the show. Well, we've been putting them in. So let's just check up how it's been performing, and we're up 0.5% for the week on the month, nearly 2% higher, and year to date, that's in fact since July 1st, it's only the month, so just shy of 2%. taking a look at some recently added stocks. We've got Steadfast, Goodman Group, Rio Tinto out, of course, just recently with its results, Midway and building products company James Hardie. Stocks that we've removed, Evolution Mining, Premium and McMahon in that financial space. And you can check out all the stocks we've been having the calls portfolio by heading to ausbiz.co/portfolio. Just a quick programming note while we're at it. Of course, we've got reporting season about to kick off next week, and we have partnered with the Motley Fool for an event to help you better understand what to look for in the results next Tuesday after the market close. You are able to ask your questions of all our guests. You can register now at ausbiz.co.register. And we're looking forward to that because we'll be talking to Marcus Bogdan, Luke Larrative, Scott Phillips, of course, from the Motley Fool, and Eleanor Swanson from Firetrail Investments. All right, let's keep going on to our next stock. And Jessica wants some analysis of Monash IVF Group. And Claude, of course, in the business of fertility, taking a note, actually, that Macquarie thinking that things could turn around for Monash because more fertility activity is expected. How are you looking at this stock?
For sure. Well, actually, this is probably my favorite idea on the list today. So thanks to the person who wrote that one in. I like your thinking. I do not own shares in this myself, but actually, it's actually quite close to the top of my watch list for potential buys. So that means I do consider it undervalued. I basically do think it's in the buy zone. It's just not one of my favorite ideas right now. I've got a few other ideas that I think are better, and that's filling up my portfolio. But it definitely looks good to me. So basically, the story here is that they're a fairly big IVF provider in Australia. I think they have some operations in Malaysia. They've got a massive weakness in their business model, which is that, the actual professionals, the fertility specialists, have a lot of power. And a few years ago, you had a whole debacle where, the CEO was there, sold some shares, quit, and then not long after that, their star fertility specialist also quit, set up in competition to Monash IVF. That's just bad luck, real disaster. You see the share price goes from $2.40 about down to where it is today, or even lower. I bought this last year when it was down at 50 something cents or whatever, because even though that was a terrible debacle, the actual business, it's not perfect because you have so much power in the control of the professionals who are essentially like employees, but at the same time, it makes sense for them to be part of a bigger group. And you can see the recovery there in the last year. I sold quite a long time ago. It was a quick trade for me, but I still think it's good value now, not least because even at the low end of guidance, this cheap on around less than 15 times price to earnings. On top of that, they've recommenced their dividend payments, which I think they paused due to COVID, because obviously, the COVID thing shut down the demand for IVF for a little bit, because for a lot of people, it stopped being such a priority. But here's the thing, if you delay doing IVF for a year, then after a year, you're probably going to want it even more than you did before, because you may be running out of time basically to have a baby. So I think a lot of that, a lot of the missed business that they've had over during the pandemic, that's still there, a lot of it. And the sad thing is, and this is actually genuinely sad, is if someone didn't go to the IVF place when they were 34, and instead they're going back when they're 36, the actual chances are they're going to need to have more cycles and pay more money for the IVF in order to get pregnant. So, yes, I agree with Macquarie, and I definitely believe that probably the next year or so for this business, or next 2 years, should be pretty strong. On top of that, you've seen some recent director buying. The price isn't demanding. On the one hand, we've got software stocks on 50, 80 times revenue. On the other hand, here we've got this business that's pretty good business for 15 times earning, 4-point-something% dividend yield. I quite like it. I'd say notionally for me it's a buy, just with the caveat that I'm not going to buy it because I've got better ideas. Okay, that's fair enough. That probably answers Jessica's question, I should say. Adam, Claude's saying essentially it's undervalued. What do you think? Yeah, and I've seen the same Macquarie note that you're sort of talking about. And if you go back a step, we're not travelling, so no one's doing these European holidays. So there's a fair bit of discretionary money sort of sitting around when you
potentially go on a holiday once a year or twice a year. And then also, you've got this family unit that's now coming back together again as far as people are wanting more children and that kind of thing. And with COVID, everyone's sort of potentially wanting to grow their family a little bit more. So, the backdrop of that means that there's more and more spending that could potentially happen in this space. MVF actually trades on a forward PE of sort of 3.2 times 12-month forward estimates, and then also represents about a 27% discount to the Small Ordinaries. So it actually seems that there is some value in this. I think it's okay. I mean, it doesn't look too bad on the chart. It looks like it's sort of forming a decent base around this 80 cent, 85 cent mark. Look, I'm going to say it's a buy with Claude as well on this one. I think it's a quick trade, though. I agree with Claude's thesis that, you don't want to stick around in this for too long. I think if you buy some here at 87, it gets to $1 or something like that. I think I'd take some money off the table. $1's a big number for this thing to get through with its past history as well. But look, they've got some attractive industry fundamentals. They're investing for the future, and they've got some different avenues for growth as well. So it actually sits up okay in this sort of COVID environment. So I think it's a quick trade, and you do okay at it.
All right. Well done, guys. A buy from both of you. It's going in the portfolio. Good one.
Just have to hope that it doesn't stay there for too long.
Yeah, okay. All right, note taken. Now let's take a look at ASX, the stock. Lily asking, is this one of the most overlooked monopolies on the market today? Now, Adam, I'm going to start with you because I seem to remember we had a promo running on ausbiz for a while and you were asked, this is a table thumper. It's a buy, and you were referring to ASX, were you not? Do you still hold that opinion?
Yes. Yeah, absolutely. I really like this story. Obviously, I'm in the markets every day, and I see how much deal flow that we're getting compared to the rest of the street, which is absolutely going crazy. Now, remember, mergers and acquisitions are fantastic for the ASX. Capital raisings are fantastic for the ASX. IPOs are fantastic for the ASX. Trading is fantastic for the ASX. And all of those numbers and all of those metrics are moving higher. So, yeah, I really like this story. I think it's a good quality blue chip stock that clients can set and forget. It's got a great dividend. It's got some more money moving in there. And I don't want to sort of, blow my own trumpet here. However, I think I was talking about this sort of in April, March this year, and it has done very well since, and I think it still can do very well. There are a couple of naysayers out there as far as they're saying that growth or that sustainable growth cannot be moved or cannot be replicated, and they're always considered worrying about these things. I do think that the long-term expectations of this business is very conservative, and they do have a sustainable growth of around about 5% per annum. So it's not huge, but also a dividend of around about 4% as well. So I really think that that's something that I think looks pretty good, looks good on the chart as well. I'm comfortable with it. I am staying with my buy on ASX.
All right. Good one. Claude? Would you agree?
Come on, Claude. Give us your real. Tell me what your first thing.
I so want to agree with you because I do agree with a lot of what you just said. And if I was a big caps guy, I reckon I'd be singing a similar tune to you on this one. I definitely agree. It's one of the better large companies. Again, got to come back to this theme. It depends what you want out of the market. This one, forget NAB. This one, I can understand why you would hold that if you're just a long-term investor because, Adam outlined perfectly that case basically. But the key thing here is that, I just think that it will keep growing. It will be a bigger business in 10 years. It's not heaps of growth, but I think you can say that with some certainty. That's different from banks and mining companies that tend to do big swings and roundabouts depending on macroeconomic stuff. This is a pretty resilient business. Obviously, sentiment affects the share price. So if sentiment goes down, its share price will go down. But the actual business itself, as long as you've got those corporate deals, there's a big stock market crash, there's a recession. Oh, you still need capital raisings. Company need to recapitalize. There's a big run up in the stock prices. There's heaps of action like we've had in the last year. And it's still good for ASX. As long as things are happening a lot in capital markets, these guys will do well out of it. So I have to say it like that. The price isn't too insane for that kind of thing. But at the same time, I can't see the thesis for, why the re-rate from here, because it does seem fairly fully valued. Yeah, I think it's, did you say 4 points? It's a decent dividend yield. I want to say it's 4 point something %. However, do I see that dividend going down to 2% because the share price is going up? Probably not. I think it probably stays within around, of current prices, just because its growth isn't that spicy. So yeah, it's a good blue chip. Definitely agree with that. But for me, because there's no real obvious cheap opportunity, I have to say it's probably more just a hold for me.
Okay, a hold, but certainly enthusiasm is continuing there for the stock ASX from Adam as a buy. Let's move on. Airtasker, of course, IPO'd early this year. Ruben wanting to know about this one. Of course, it's all eyes on its push into the States. That's the next big market. Claude, how's it going?
Look, this is a cool Aussie startup, which I love to see, and so I'm definitely watching it with a lot of interest. However, what we do also, I think that the thing, I guess I'm channeling Rudy a little bit here, but the thing about Airtasker is that it is a recent IPO, and it also did IPO with a lot of fanfare, and perhaps, Adam might have some interesting perspective from the broker side of things here, but it did IPO with a lot of fanfare, and like the share price graph shows that it spiked up to above $1.60, right? And now it's been down ever since. And basically, I just think, even though this is a business that is good enough to definitely have on your watch list and definitely have a price that you're willing to pay for it, I think what happens is if you're buying now, you're buying into like massive excitement, still a lot of expectation. These guys have $45 million in cash from memory. They're going to need to be using that cash, and they will. They're going to. This is a decent strategy, by the way, a great strategy. But they're going to use that cash, and they're going to try and crack into a bigger market and become a much bigger company. But I think that the time when I'm going to be looking to try and buy shares is when they've been spending all that cash and losing heaps of money trying to make progress somewhere, but they're not getting any extra revenues from it yet. And their financials are going to look way worse than they already look. And, already right now, these guys are burning cash in the last quarter. Even putting aside business acquisitions, so these guys are already burning cash now. They're going to spend more money. There's going to be some serious cash burn going on as they try to build this sort of network thing. And then the other thing you got to remember is once it's listed for longer, we're going to have a better idea of actually how resilient and good this Airtasker sort of platform and concept is. Because one of the things that kept me out of the stock, aside from just the risk of an IPO, the main thing that kept me out of it is when I was doing my research and doing a bit of customer. I've even signed up and done a task on Airtasker and all this sort of stuff. But I'll tell you, it makes no sense to me why somebody, wouldn't just say to the person when they've done the job the first time, hey, do you want me to come back and do your lawns again? Or do you need help with this again in the future? And then you just cut out Airtasker. So I'm just not super confident about how, how well the Airtasker platform will capture ongoing business. So yeah, for me, I think I'd probably find high pages a little more interesting in this space because of that focus on tradies, and tradies tend to be there more for the one-off job more. But that's just a side thought, really. I don't own either of them, and I have to say, Airtasker is just a wait and see one for me at the moment. I just want to see more data.
So it's a wait for Claude. Adam, Claude makes a good point there. No better research than actually using the product. So have you done that?
Yeah. I've used the product before, and actually it's quite good. But I totally agree with Claude as far as that. You can get their business card and don't have to go through Airtasker's platform again. And obviously they've tried to make some steps to sort of stop that, going forward. Look, the stock has got around about 46 million cash in the bank at the moment. So they're fairly well cashed up, and obviously post the IPO. But from memory, I think that they did the IPO, but then they raised some capital within 3 months after the IPO as well to move into the US. So I think the market is always skeptical about companies looking to, in this investment phase to look to go to greater markets. Obviously, they've got a mature market here in Australia, but then moving to the US is always, and the UK is always going to be a pretty daunting task for these guys. But if we start to see attraction in the US and the UK, then I think that this one will, and they can demonstrate a good return on investment, I think this one is going to be okay. For me, there's not enough water under the bridge. It would be a hold for me if you do own it. From memory, I think it was about $1.25 IPO, so you're probably a little bit underwater here. Most brokers have got price targets around $1.28 to $1.30, so just be a little bit cautious here. But look, if they can show us the growth numbers in the US, they can show us the growth numbers in the UK, and they can say that they've got a good return on investment, then I would be more considerate about buying this one. But at the moment, it's a hold from me.
Okay, a bit of a wait and see from both Claude and Adam there. All right, we're falling behind. Better get moving. Worley, this one from Fred. Of course, mining services company. You would think any company associated in the commodity space that benefits from that would be doing well. Adam, how are you looking at Worley at the moment?
Yeah, look, it's a big business. It's got a huge headcount as well. I mean, I think that there's about 48,000 in sort of employees on this business, so it's absolutely massive. One of the interesting things that I do like about this, and I'll be quick, it's a hold from me. The reason why I like it is they have unveiled a pathway to become ESG, as my rabbit is, ESG compliant, and looking at some of these businesses where they can get more efficiencies out of it. I think that's a right move for the business. That's taking away a little bit of revenue now, but for the future, I think this one looks okay. So look, I like the story. I like the business. It's moving away from oil and gas, moving into sort of more decarbonisation, as well as some other areas that needs that help. So look, I think it's an okay business. It's a hold for me at the moment.
Okay, Claude?
For me, Worley would be an avoid just based on its sort of industry. So these kind of services businesses for the mining industry tend to be very up and down, and the 5-year chart that we're just looking at shows that, but the 10-year chart looks even worse. It shows that the share price has halved since 10 years ago. So that just shows they're the kind of stock where you really need to time the market, and that whole headspace of being in a stock where you have to time the market, I want to have like a clear, like, I'm buying now, X is going to happen, and then I'm going to sell whether I'm right or not. But I don't really see that for Worley Parsons. It's also such a big business. It's like super macro, what affects it as well. So it would be in the realm of like the macro call really for me, which is, again, just it's not the best place to fish in the stock market. And so I would say, with my long-term investor hat on, I'd avoid this one.
All right, and avoid from Claude, a hold from Adam. And to our last stock, and it is United Malt Group. We're sort of ending up where we started in a way in terms of ag-related businesses. Of course, Claude, this was spun off from Graincorp last year.
Yeah. So I like this one. There's been a potential value play, and value investors have sort of seen and argued probably correctly that it has been fairly cheap in the past. But with the share price sort of coming up a little bit recently, and also revenue down 11%, and EBITDA down. Basically, the most recent results weren't particularly good, and it's a bit of a valuable, like, it's a value play. You have to get excited about the sort of valueness of it. So I think if you're buying this at $3.50 or whatever, now is probably when actually you might be selling and just taking the profit from the re-rate. So for me, it's probably a sell now or maybe a hold at best. It's just not a high enough quality business for me to want to own. There's a lot of moving parts. A 2 cents interim dividend implies it's not going to be a massive dividend yield. It's just not cheap enough for the kind of business it is, basically, because it's always going to be up and down depending on volumes and that kind of thing.
Right. Okay. Adam, would you agree?
Yeah, look, it's a tough one because obviously it's all about beer consumption. And if you look into beer consumption, then certainly a lot of the microbreweries are doing a lot better than the big Carlton United breweries as such as well. So beer consumption is actually probably down, or there's been a decline in beer consumption across most of the areas. However, United Malt Group has 13 processing plants around the world: Canada, United States, UK, Australia. And it operates a very large business of full service offering for craft brewers and distillers as well. So, look, I think there's a fair bit of risk involved with this one. COVID-19 is definitely one. A decline in the beer consumption is another one. Changing in the amount of malt that is used in the beer production if beer production is lower, as well as supply chain disruptions from COVID and those kinds of things as well. So, look, for me, it's a hold. I'm sort of, I like beer, and I think with everybody else, beer is changing, and the way people are drinking are changing. And I heard Constellation Brands yesterday and Diego talking about how their tequila brands, their vodka brands, those kinds of things are absolutely going skyrocketing. So I think beer potentially is getting left a bit out of that. And I think that is one of the reasons why I'd say it's a hold or be careful with this one.
All right, hope that answers the question from Charlotte. So just summing up there, the last 5 stocks started with a goodie. Monash, IVF, it's undervalued, saying Claude, plenty of discretionary cash, but be quick, says Adam, it is a buy from both. That means it's in the portfolio. ASX, current market, it's good. Set and forget, says Adam, it's a buy, but it's a hold from Claude, saying it's fully valued. Airtasker, pretty much a wait and see from both, I guess, given its expansion plans into the States, recently IPO'd, of course, well cashed up, saying Adam. And Worley, a hold from Adam, ESG compliant, that's obviously a positive, but it's an avoid from Claude, just too volatile in that mining services space at the moment. And United Malt Group, a sell from Claude, given the recent results, not great. Adam's saying it's a hold. He loves beer. Who would have guessed?
Only on Friday nights with you, Andrew.
Yeah, yeah, that's right. We miss those, don't we? Let's get rid of this this current lockdown. All right, hey guys, terrific to have your company on the show. Claude from A Rich Life, thanks so much. Adam from Shaw and Partners, as always. Cheers, guys.
Thanks, guys. Have a good day.
And of course, any stocks you'd like us to cover, flick us an email, the call at ausbiz.com.au, or you can tweet us at ausbiztv. And a reminder to find all the stocks we have in the calls portfolio, you can head to ausbiz.co/portfolio. All right, don't forget to subscribe to the Ausbiz newsletter too, where you get all the different views, Scuddy's View, the COB podcast, popular videos. You can subscribe at ausbiz.co/the COB. Thanks for watching.